unable to do it, but it's
Good morning, good afternoon, good evening, everyone, and welcome to our festive edition of AML Watcher's most recent webinar, Making Synthetic Data Work for Transaction Monitoring. So we have an incredible set of panelists lined up today: academia, legal, on the ground, boots compliance, seasoned compliance officers. So really excited about what we're going to be able to bring to the table today. But just to kind of set the scene on what we're going to be talking about. So today, I think every one of us will be aware, we're really at a crossroads of technology, regulation, and the future of financial crime prevention. And what does that mean in respect of our data? Well, we need to make the data work for our systems. And as a result of that, we need to really take a step back, understand the data in our books, but also understand the gaps in our data and how we can plug those gaps in order to support the right technology to help us identify potentially highly complex risks in our book, including secondary sanction exposure. But before we get started, for those in the room, like myself, who like to go back to basics, what is synthetic data? Well, synthetic data is basically artificially generated data that mimics statistical patterns, relationships, and behaviors of real data without containing any actual personal or sensitive information. So it's a wonderful use case for basically simulations within our models, within the tech that we have, without kind of any GDPR data protection issues. It looks and behaves like real data. It contains, as I mentioned, no real customer records, and it allows us to test and train and also innovate without regulatory risk, i.e. we're not exposing actual or sensitive data. But why does this matter? Well, right now, this is incredibly important because our current systems within AML and fraud are designed to detect crime after it's already visible. Most of our systems are basically set to known risks. So we basically detect once we see it previously. Now, what we need to do to future-proof our business is to simulate before we see it, i.e. that we need systems in place with the right data inputs that actually can simulate potential scenarios of financial crime that could happen within our books based on our risk exposures. And to do that, we need synthetic data. So let's be clear here, however, synthetic data, it's not fake data. It's statistically accurate, it's privacy safe, and it's built to stress test our controls, expose blind points, and train models before the risk arrives. So what does that mean for us? Well, skill sets in compliance will need to be improved, and we need to upskill in order to support this. How also do we make use of existing data lakes? And is there any challenges within that? And last but not least, what role will technology and AI play in the fight against financial crime over the next 2 to 5 years? And that's exactly what we're here to unpack. So without further ado, a very short intro, that's the end of the webinar, folks. So without further ado, it's my absolute pleasure to introduce our esteemed speakers, two of whom I've had the absolute pleasure of getting to know and work with, and I adore them. Eric, I hope that we also get that same level of our relationship moving forward. But without further ado, I'm going to introduce each of our panel members and ask them to give a quick 2-minute intro. So first and foremost, actually, Eric, if I may, to yourself, Eric Altman from IBM.
Thank you very much, Una, for that excellent introduction. Yes, I'm at IBM, more specifically the IBM T.J. Watson Research Center, which is near New York City. I've been at IBM for more than 25 years after I got my PhD in 1995, and I got my my undergraduate degree from MIT in computer science and a second degree in economics. And so with all of that, I have got a lot of background in AI, statistics, signal processing, but actually my PhD was in compilers and computer architecture. So moving into AML, financial fraud is something of a switch for me, but I've been very actively involved in that for more than 5 years at this point. IBM mainframes process more than 70% of the world's transactions, so it's very important to us at IBM to have effective systems and software and monitoring systems so that banks and our other clients can effectively deal with these problems. And so and part of that is building effective systems, and to do that you need both high quality models and high quality data. As I think we'll probably get into today, real data is not necessarily readily available except to banks and other restricted entities that have that. So IBM, we needed more. We also see a broader opportunity to bring in a much broader set of people to look at these problems. We've made so many strides in so many areas with AI, and I think, as you suggested, Una, we're posed to do that. So that's by way of background. My motivation in getting into this was to help IBM and to try and expand the set of people that could attack these very important problems, but who have been unable to historically, oftentimes, because of a lack of high quality data. Realistic data, as you suggested. So I've had to pull together a lot of my background skills, not just in AI and statistics, but the sort of computer architecture sort of stuff, because these are big, complicated pieces of software, and so it's important to make them run efficiently, or they won't run at all. So anyway, that's a thumbnail about me and my motivations and background.
Amazing. Well, Eric, it's wonderful to have you today. All I heard from your academic background was overachiever. So it's great to have you here. And honestly, your experience is phenomenal. So I'm really, really excited for this discussion. So thank you. Next, may I introduce Pallavi from the Bank of China, who I have the pleasure of also calling a friend. I've known Pallavi for a couple of years now, possibly one of the best speakers in our industry, but don't get her started on Game of Thrones. So I will pass it over to Pallavi to do a quick introduction.
So I'm Pallavi. Good afternoon, good morning, good evening, everywhere to everyone. So I currently, as Unag mentioned, currently working in the second line of defense with Bank of China, and I have been a traditional banker all my life yet. So I'm still not bored. I still love my job. I'm still passionate for financial crime. So I have always had the focus on fraud prevention, investigations, anti-money laundering, counter-terrorist financing, transaction monitoring. Yes, so these are my key core, what you can say, favorite subjects and favorite things which I have come. So a lot of work I've been doing on fraud prevention and AML, and I believe a lot of work is around intelligence rather than just going on the solution directly, which currently the financial crime industry is just jumping onto conclusions and solutions, which should not be the case, because look inside first how much data, what valuable data you are having in your banks, in your organizations, and start it all from there. So yeah, very much like when the webinar is continuing, I've got plenty of live cases which I have worked on in fraud prevention, in AML, on money muling, on romance scams. A big, what you can say, a big directory of live cases I carry, and I have always been working on that one. So yes, so happy to be here, and happy Unag is hosting this one. So yes, one of my very, very good friends. Yes, thank you very much.
Thank you, Pallavi. Thank you so much. And last but not least, we have Nafisa. I have to say, I'm very happy that Nafisa had the sense of marrying an Irishman, so I could more easily pronounce her surname. So she currently is Nafisa Fine, but before that, she made my life as a moderator very difficult by her surname being Abdullah Eva. And I hope I pronounced that correctly too. Nafisa is joining us from Paynit. Again, a good friend of mine. We've had a lot of laughter and fun over dinners recently. So Nafisa, I will pass it over to you.
Thank you. Yeah, I'm Nafisa Fini, and I'm General Manager of Paint Ltd, UK entity, and Head of Legal. My background is legal. I did my PhD. However, the PhD in law was done on insurance liability. So sometimes people ask me, how did you move from insurance to the fintech sector and others? But anyone who worked in insurance could understand that if you understood insurance, you could understood other regulatory business much more easier than the insurance regulations. Well, in terms of the like I will be 50 soon, and if someone would tell me that when I was a law graduate, that some days we will talk about the artificial intelligence and synthetic data, I would say what's that about? So that's why I find it extremely interesting and exciting where we are now. And I would say that artificial intelligence, I consider as the second industrial revolution, how it like changes the world around us, and our everyday life and work is extremely interesting, especially when it is like in a crossroads with the ethics, law, regulations, technology, financial institutions, fraud. Everything is embedded. So happy to join for the discussion today.
Wonderful. Thank you so much, Nafisa. And I couldn't agree with you more. We really are at, I like yourself, like Pallavi, like Eric, we've all been in the industry a significant amount of years. Let's not mention how many. And I think between all of us, we're well over the 100 mark, and in terms of years. But one of the things that I say time and time again is that we are at a point in the development of basically the financial industry that will probably never happen again, and has never happened before. This is the next evolution of financial services. When we went from bartering to cash to automated services, and now we're moving to the digitalized world, including digital assets, and as you mentioned, AI. So that's actually what keeps me excited every day, because there's not a day that I wake up and I'm not learning something new in our industry. And I love that. I love that for me, and I love that for everybody in our industry. So starting off, and I'm conscious we have now 45 minutes, and that's great. Everybody, please ask as many questions as you want. That's what we're here for. But we will actually just kind of take this from the very foundation and then build up in complexity of the discussion around synthetic data. So kind of, if Eric, if you don't mind, kind of starting with the origin of synthetic data. Obviously, synthetic data isn't something that's new. It's been used since the 1990s in privacy research, statistical modeling, and also in early machine learning in the research space. Obviously, there's been now a big change since the 1990s, bringing that over to where we are now, 2025. Shifted from academic theory to a core enabler for AI development, and obviously being able to use that synthetic data for supervisory sandboxes and simulation of financial crimes and advanced model validation. So could you maybe just talk to that briefly about that evolution from academia through to what we're seeing today from a modern application? Oh, I think you're on mute.
Eric.
Sorry about that. So I hope you can hear me now. Yeah, so a lot of early efforts with synthetic data would actually assume that you had some amount of real data to start, and that works in a lot of other fields. But for this field, as we've sort of discussed before, real data is often not available, and even if you have it and you make something based off it, it's often not widely. You can't disseminate it to a broad set of people for privacy and other sort of concerns. So one of the things that's happened recently, and we've worked a lot on this, as have others at AI Sweden, at the Bank for International Settlements, and many other places, is to build models that are agent-based virtual world models. And so what I mean by that is we instantiate fake people, fake companies, but we model them based on, as you indicated, realistic statistics from the census, from the Federal Reserve, from the European Central Bank, from labor statistics put out by governments, lots of statistical distributions. Essentially, you get thousands of distributions, and so you can instantiate these businesses, these people with realistic characteristics that sort of mimic the whole population, but you're not saying that a particular person is based on Eric Altman or on Una or Pallavi. It's based overall. You get a distribution of people just like real people, and that mimics reality. And the nice thing is, if you're doing a rich version of this with thousands of distributions to characterize these things, just like real people, real businesses, no two people, no two businesses are the same, and you can get all sorts of variations. And this leads, I think, to lots of richness that you alluded to, Una, in terms of being able to generate data that is close to reality, but you can maybe push it in particular directions. I mean, what if you want to assume there are lots of trade issues in the world right now? What if you want to generate data that looks like maybe trade is more restricted, or there's even more online than there is now, or some new industry takes off, so you want to say dining out, instead of being, say, 10% of individual spending, is 20%. I'm just making these numbers up, but it allows lots of room for playing. But it also lets us vary fraud levels and behaviors. So one of the issues that you suggested, Una, is sort of how do we get ahead of where criminals are? We're sort of with real data, we're limited to what people have done historically. And so one of the big advances, I think, is being able to have interesting characterizations of criminal behavior, of patterns of how people launder, of where they get the funds to launder, and so forth. And so I think there's a lot that's been done, but I think there's even more that's yet to do. I mean, and we can maybe get into that a little bit more, but one of the really interesting, slightly longer term things to me is what if scenarios or counterfactuals. I mean, so we have a set of data that represents a certain state. We see how well the model does. Then we tweak the data and see how well the model does again. And if we have a set of, say, creative people who are just like in movies or novels, pretending to be criminals and coming up with good schemes, we can essentially now, I think, reflect that in data, and then we can see how well the models do. So we're only limited by our imaginations, and I think that lets us potentially get, I hope, well ahead of the criminal element, and able to stop and detect a lot of these things before they actually occur in reality. Anyway, I'll pause there.
No, please. Honestly, I, for one, find this absolutely phenomenal in terms of what this is going to do as a game changer for the kind of financial crime toolkits that we use. And one of the things that was mentioned earlier was about kind of, I think you mentioned it in your introduction, Eric, about kind of financial institutions have a lot of information, but the truth is there are gaps in that data. And, we will see a segmented part of that data in our books. We won't necessarily see the entire picture. That entire picture will come through the interconnection of third parties, which, to be honest, regulators, FIUs, should be kind of looking at that mainframe and looking at that spidergram in more detail. So, sorry, I'm losing my voice here. So synthetic data really gives us the ability to plug those gaps in our data by providing volume, variety, and kind of that edge case coverage that real data can't provide us because of the current gaps that we have. But if you don't mind, Eric, me asking you, why has synthetic data become essential in the era of AI-driven financial crime detection? We have a lot of data in our books, but so what really is the added advantage that synthetic data is going to bring to us?
I think it brings in addition to everything I just said, real data is not accurately labeled. Unfortunately, as all of us in this area know, 90+% of money laundering tends to go undetected. With synthetic data developed the way we are and others are, exactly who the criminals are, exactly what funds they're moving around in an attempt to launder it. How they're doing it, which banks. So you can cover the entire banking ecosystem. You have ground truth, exactly what's laundering, and you even have things like cash transactions, which are largely invisible to traditional sort of methods. So it gives this whole this whole sort of universe view. You're never going to get all that with real data, but having a sort of perspective on it and developing models where you can maybe infer some of the hidden state, I think it makes things really valuable and different now. And the fact that we've been at this sort of missing 90% for many years, unfortunately, I think suggests that we need a change in direction from how we've attacked these problems historically. And I think synthetic data lays the foundation to be able to switch and build models and be able to test them. I mean, we can say Bank A has a model that's detecting 80% and B has one that's only detecting 50%. And so competition is good, and we can with synthetic data we don't have to disclose anything real, and we can let everybody compete against each other, and then sort of let best practices be carried over from one place to another, and all sort of build. We see this in many other areas, and I think we can also see it over the next few years in money laundering and anti-money laundering.
Yeah, absolutely. And that kind of 90 to 95% that Eric is referring to is with regards to kind of the current capabilities of rules and scenario-based transaction monitoring systems. This won't be a new statistic to many people, but as Eric rightly said, if you take a step back and you ask, why are we using systems that are only producing a 5% accuracy, normally maximum 8% accuracy? The bigger question is, well, clearly they're not fit for purpose and something's broken. And as Eric rightly said, we need a fundamental change and a transformative change. And what does that mean? Well, that means better technology. But in order to implement that better technology, obviously we need better data. And Pallavi, if you don't mind kind of me moving this question to you, and one of the recent kind of stats this year that I've come across at various conferences, which blew my mind, but actually didn't surprise me at all, was that as part of onboarding, if we go through all of the quite prescriptive onboarding KYC requirements, each company for each client is generally obtaining around 1,200 data points per customer. But in reality, day to day, we use approximately 100 of those data points. So we're leaving around 1,100 data points on the shelf. Why Pallavi, is that? What do you think is really driving that?
I could always put that point on having legacy systems. Now, not all banks. So what has happened is, the criminals are currently traveling like Arya Stark, who runs through the streets of Bravos, and she is not to be caught. So the criminals are using it so nicely, and they are leveraging on all these weak points which sit in banks. Now, to change anything on a banking system, you might need so many, what you can say, layers of approval. And by the time you start putting those things in, that person has already left the organization. So again, it all goes back to square one. And financial crime, when I started my career 12 years ago, it was quite like, okay, it was a fraud prevention system, then a transaction monitoring system, a KYC system, and it was all sitting very nicely in silos. And now the data what they have also sits in silos. So we are not able to go and just ask. So if I have somebody on the fraud prevention, something has happened on one account, I have to go back and check on the KYC. So these fragments have already been there. In fact, criminals are much faster in adopting this, what you can say, the speed of model, the speed of technology, so much innovation. The criminals are taking very good advantage of it. But when it comes on to the banking side, especially on the traditional banking, because my background has been in traditional banking with the high street banks and with a small team now, it is just what you can say, the systems which they have. They are running it since many years. That same data is been recycled since many years, and no new points are just coming in. So you'll be like, okay, fine. But there is some till the time the customer gets up and says, oh, I'm a victim of a scam, I'm a victim of a fraud. And then we'll be like, okay, something new is happening here. You start taking those red flags into account, and then you start building them up on the systems. So yes, I can put a lot of things going back to the legacy data, legacy systems as well, and data working in silos as well. So these teams, I was just speaking to somebody yesterday, and when somebody asked, I asked a question. I'm like, I don't know anything in crypto. I really don't know how does it work. What is the best point to go and start learning on crypto? And she mentioned chain analysis certification is good, where you can start looking into it. So then the conversation turned to that how financial crime roles have evolved as well. It is no longer a KYC analyst or a fraud analyst or a transaction monitoring analyst. Now it should be KYC, fraud, and transaction monitoring sitting all in one team. And then comes the AML and sanctions in one team, and add the cyber as well somewhere. So that the way the criminals are evolving, the roles in financial crime needs to start evolving as well.
Pallavi, that was a nice plug for chain analysis training. Well done.
Oh yeah, I don't know. I've still not seen it.
Pallavi there. No.
I don't even know. My New Year goal.
Fast training.
Yes.
But no, you're absolutely right in what you said. Data remains siloed across onboarding tools, client relationship management tools, document repositories. And this is my biggest bugbear. And I was actually talking about it again this week. Somebody asked me, what is my biggest frustration in financial crime compliance? And the answer is our controls are architecturally designed around regulatory evidence, not data intelligence. Mm-hmm. So KYC data is captured to prove compliance, then effectively it's parked. And that has been our biggest detriment and danger in the development of financial crime controls and detection to date, because legacy TM and screening systems, they've never been designed to ingest features of customers. So basically, they are narrowly subsetted and they're mapped to rules and models. And data is so scattered across different areas within the bank, as you rightly mentioned, Pallavi, with limited integration or feature engineering, that organizations have become data rich, but insight poor. And that's not because the data doesn't exist. Rather, it's because the tooling, the models, and the ownership structures to exploit it were never built. And that is, for me, that is my biggest frustration in our work to date. We have not made people accountable for data, and as a result, on how to use data, or ask the questions, why are we collecting all this KYC data? Why are we taking 3 months to onboard a customer and we have to go through these 72 sequential steps? What's the purpose of this data? Oh, because it's a regulatory requirement. What do you do with it? We just park it on a shelf and we move on once we've risk rated them and they're onboarded. So we've never, as compliance officers, we have never been trained with the skill sets necessary to basically exploit the capabilities that are within the data. And as a result, we never built the systems. So that's...
To just give you another example on that, Unag, when a mule is onboarded on the system, on the first day, he doesn't start behaving as a mule on the first day itself. So you have onboarded that mule. You don't even know. It is just a normal customer. You've got him on the system, fine. And the mule behavior will start kicking in after 3 to 6 months. And one thing I have noticed in my entire career, that when a new account is opened, that account is not placed under extra monitoring or review till the time. There should be like a timeline of 6 to 12 months, whereas the mules are so smart. If they are opening the account on first day, second day the funds are in, and third day it is just straight out of the system and the account stays dormant. So end of the day, till the time it is not reported to the bank, you don't even know that he was a mule on the system. So, I mean, that you have onboarded it, but the extra controls, the monitoring needs to start from the day of onboarding itself. But it is pushing a lot of pressure on all the operational teams, because end of the day, it is increasing your burden to work as well. So, yeah.
But you could also argue, I always make the point, you'd have to be an idiot to open a high-risk account if you want to launder money. That's the truth, or commit financial crime. And, so the people that do open high-risk accounts and do commit financial crime basically are idiots. And it's a very, they'd be very immature financial crime actors. But many modern day money mules, these are existing accounts that have probably been held for months, years of just individuals on the street who inadvertently have become money mules because of circumstances, whether that's, you can earn, £200-300 a week, posting pictures of videos or, liking videos on YouTube and then helping us to send money to other people who like them. So what's happening nowadays is the criminals are looking for ways in which they can psychologically manipulate individuals to inadvertently make them into criminals, i.e., we know that you have a financial constraint, you're a student, you're in a low income family, you're retired, and your pension isn't sufficient to cover your day-to-day expenses, which is a real issue. So we can actually help top that up. Of course, people are going to jump at this. It looks legitimate. You're given an employment contract, and you then start helping them out. And unbeknown to you, you've become a money mule, and you then could be guilty of financial crime yourself. So I think that's something that's the way in which financial crime has evolved is frightening. We've got that mass financial crime with the money mules, pig butchering, romance scams. But on the other side, we then have really sophisticated kind of, how can I say this, kind of high value financial crimes where, for example, sanctions circumvention, which is only through RCAs, relationships and close associates. And we currently don't see the wood for the trees because we're not able to look for those connections within the book based on the TM tools that we have. You would need to continually apply forensic reviews to those accounts to even begin to identify it, because it will be a secondary or a third exposure that's even outside of our remit. So this is something we're at an intersection where regulatory compliance is not going to be a get out of jail free card for you. Unfortunately, if the regulators can actually show that there are tools in the market that could have helped you support those reviews and investigations into accounts, unfortunately, that's where they're going to say, you had the data. If you'd only used the right tools based on your risk exposure, you could have identified it. So as we mentioned before, we talked about data lakes. And so if you, Nafisa, sorry, I've been kind of trying to get, I'm talking too much for moderators. I need to stop talking. Nafisa, data lakes. So we have existing data lakes within organizations which are our transaction monitoring systems are tied to. Why are those data lakes outdated? And would those data lakes be sufficient if we had them cleaned up to basically identify more risk in our book, or is there still gaps in our data?
Well, of course, there is still gaps in the data, and why it happens, it's obvious that it happens because immaturity of the organizations, of the controls within these organizations, and probably might say that because of the regulator is not. You already told that the chief compliance officers are not looking very well on these things. But what is the regulator says on that? Let's look on if you look on the FCA and ICO, they have not formally declared synthetic data to be anonymized by default, if you look on that. So what does it mean? From regulatory perspective, synthetic data is really currently on a very interesting space, and that's why maybe we can see that's what's going. So we have what we have across the UK and EU. Regulators recognize synthetic data as a promising pet. Pet is not like a pet as a. I know, Una, you have a lovely dog. I have a Jack Russell. So pet is a privacy enhancing technology. So it's a promising privacy enhancing technology. Just imagine on this like combination of the words. It looks like very really sounds very exciting, but with important tweaks. So what does it mean? It's only considered anonymized if it is generated and validated properly. So UK, if we will take in UK, FCA and ICO, the ICO anonymization code of practice, they have this, make it very clear. The output can be recognized as anonymized, but the treating process remains processing of personal data. So organizations still we need to have this lawful basis, otherwise like like Article 6 GDPR, UK GDPR will find your street. So, or like purpose limitation, DPIA, technical and organizational control. So all these kind of things from regulatory perspective, synthetic data is no longer seen as a novelty, but it's increasingly as a privacy enhancing technology. And in some circumstances is I would say it's legitimized anonymization strategy. That's what, and that's why the FCA doesn't issue a policy. We don't see like a policy itself as it is on its position. What do they think about the synthetic data? But its actions actually speaks quite like loudly, because they have this now sandbox where they encourage the firms to use the synthetic data, and it created, I think, 2024, probably, yeah, it wasn't 2025, it was 2024, was Synthetic Data Expert Group. So when they had published for financial institutions on the, and there is also the provisions of the leakage of the information into the advanced, the responsible use of synthetic data in financing service. That's what like it says, and it gives the some kind of the guidance on that. So they explicitly frame synthetic data as a pet, as I told, but that like with a we'd say like they allow more robust ML models, testing, enable fraud, AML innovation, improve resilience, and they say it's a system testing. So for the system testing, fine. Yeah, that's probably what I would consider on that. But again, this is the same detection regulation.
And I really appreciate the piece. So you've really, and what I love there is you've deep dived into kind of the regulatory view on synthetic data. And, you know, as you rightly said, the FCA, the ICO, the European, Commission, they've all acknowledged that synthetic data is an innovation enabler. But acceptance of using synthetic data requires strong validation and governance around it. And we have, as you rightly said, you can use synthetic data, but you must demonstrate sound validation, clear governance, and an understanding of its limits. If there is seen to be any kind of pollution of real data into your synthetic data, you're going to have a significant GDPR issue. And we have seen, as you said, the FCA has established a synthetic data expert group and published a report on the usage of synthetic data in financial institutions. The FCA, the ICO, and the Alan Turing Institute have also collaborated around validation and privacy. And the European Commission obviously have highlighted the synthetic data as a tool to support privacy, preserving analytics and data sharing is absolutely possible, but caution, make sure that you can explain the explainability model, i.e. validation, and there's no pollution with real data and governance. So just on that note, actually, just Nafisa, just before kind of I move on to the next question, how do we validate synthetic data from, and maybe Eric, you'd want to jump in here as well. How do we validate synthetic data for model risk and supervisory expectations, making sure that it covers privacy and model behavior consistency, documentation, testing, and monitoring? Like, how are we going to be able to do that? And what kind of experience and skill sets will we need to have within the industry to support that?
So I can say a couple of things. So with there are multiple ways of generating data. The way we do it, we take only population statistics, never individual information. So I think there's not the same sort of issue as if you have, say, a set of real bank records and you try and use, say, differential privacy techniques to create a new set of data which doesn't represent the real people. And there you have basically tuning parameters which say, how much fidelity does the new data, synthetic data, have to compared to the original data, and sort of the harder it is to reverse engineer and figure out who the original people were and their attributes, the sort of lower the quality of the data. The alternative are these population-based statistics, which is the approach that we've preferred. And I think in terms of validating them, there are lots of the statistics, the real statistics to which one can compare. I mean, you can say, what are people's incomes? How do they spend money in aggregate? And then there's also just the sort of bottom up part. Is the model accurately representing how the world works? I mean, you wouldn't want people to be doing the majority of their shopping in the middle of the night, or to be doing the majority of their shopping in a country that's 8,000 kilometers away from where they live.
Yeah.
Those are sort of trivial things, but you can look both statistically and I think you can look with just sort of humans sort of sampling the data and saying, yes, this looks reasonable. And it's sort of, maybe arcane as it sounds in this era of AI, we found there's, in addition to doing all the statistical tests, there's no substitute for human sampling of the data. They're just sort of patterns. This sequence of synthetic transactions you're generating doesn't look right, and then you can go in and tweak how the data is generated.
And I think really
and ethics simulations as well. So basically, like, the formula could look like very like easy, but it's not that easy. So fidelity tests.
Yes.
Then membership tests, then as it was told, similarity checks, and then ethics simulations. However, then the difficulty is not in the technical part of that, but in documenting this process. So the generation process should be properly documented. It's a model architecture, it's a privacy mechanisms, like parameters, and of course governance and controls. So this is probably,
and this really is going to give us a strategic opportunity to position synthetic data as a privacy enhancing technology rather than a loophole. But fully synthetic data, it cannot, under GDPR, cannot be linked back to real individuals. And it has to fall outside the scope of personal data. And I think we've seen, even in the UK, the ICO published a recent anonymization guidance, that we need to understand the strengths and weaknesses of anonymization. And synthetic data does differ from anonymized data, i.e., we must include synthetic data and treat it as part of our accountability framework, but we cannot tie it back to real individuals. So even where, and Eric, just on that, so how does synthetic data differ from anonymization? We're taking existing data, but we're removing the kind of the key parameters, the identifying kind of particles of the customer. What is the difference between synthetic data and anonymization?
Okay, well, anonymization takes data from real individuals. So you might say Eric Altman today gets coffee, he buys lunch, he buys a new shirt, he orders some electronics online, he transfers money from his checking account to his investment account. So you can get all of these individual sort of things. And of course, if you release that about me or any other person, there are huge privacy implications. So anonymization is an attempt to obfuscate that, to make somebody or who looks sort of like me, but doesn't have all of my characteristics. So you can't sort of infer my attributes based on looking at the data. The other approach is to say, overall, the population looks like this. People shop at clothing stores this much. They pay their rent. Here's the distribution of rents, amounts. People, how often do people pay it? Typically monthly, but sometimes other frequencies. People pay for insurance, and so you can take these statistical distributions of amounts and frequencies and then use that to synthesize data, which is not then, of course, based on any real individual and does not have the anonymization concerns that you're going to be able to figure out that Eric Altman paid his utility bill today for this amount.
Yeah.
So I think there's really a fundamental difference there, and my bias certainly is towards the latter, the population-based statistics, which I think also let us tie together many areas. I mean, we've talked about things like romance scams and other sorts of things. I mean, that of course is an important source of seed money for many criminal operations. So with synthetic data, you can generate not just the movement of funds, but you can generate the initial sources. Most things will be legitimate, but you will have these scams, and so then you can really see placement layering the entire sort of money laundering process and how things flow. You can also tie it to other things. I mean, what data is actually important to detecting money laundering? If you have access, say, to someone's credit card transactions or their record of insurance claims, we don't necessarily, for good privacy reasons, we don't generally know that. But if we could say these three things, looking at synthetic data, look like they're really important to understanding money laundering, then we could try and figure out appropriate privacy preserving ways to pool this data and hopefully make a dent in the money laundering problem.
And one of the things that we've mentioned, please go ahead, Nafisa.
I will jump because the first part
nobody else gets to speak but me on this webinar. Sorry, what?
Yeah, I tried to be quiet. So can I just add what do I see in the problem with the GDPR in relation to that? So under GDPR, anonymization must meet an extremely high threshold. So it's irreversible, no re-identification, and resilient to future technological progress. So why it's so difficult? Because synthetic data can meet this threshold if it doesn't replicate individual records, so no memorization, just like no memorization, and no reverse mapping to a real person is possible. Privacy is measured using different quantitative methods. It's different inference tests, similar metrics, and regulatory wants. What regulatory says that poorly generated synthetic data is still a personal data. That's why it's it's quite difficult to follow in this.
I know, and absolutely. And you mentioned there about real data as well, Nafisa, and that actually was going to be kind of the next comment that I made in the next discussion here. Before we move in to kind of how will this help us get ahead of evolving typologies. We've talked about synthetic data being a wonderful tool for plugging gaps in our data. And then the question is, if we used all of our onboarding data, would we need synthetic data? But one of the things that we didn't mention is synthetic data solves a different problem as well. Real data reflects what's already happened. Synthetic data lets you model for what could happen, i.e. future-proofing. It simulates rare, emerging, and blended typologies and supports proactive tuning of our systems. So the truth is, while synthetic data is used to plug real data, as in today, it then can also be used to model for potential future case scenarios. And that is really what's going to help us to bridge, these kind of the challenges we have, where even with perfect real data, they will never be enough for us to help identify pig butchering scam chains, cross-border mules, or new scam hybrids. Synthetic data plugs that gap in a future-proofing way and allows us to stress test. It's not a replacement for real data, it's a multiplier. So on that note, Pallavi, to the exciting question, drum roll, here we go. How will synthetic data get us ahead, I said, of evolving fraud typologies?
It should. I mean, it will be a very good advantage because all the time is been spent on looking at the same rules on the transaction monitoring rule-based system and then fraud prevention real-time system as well. So these things are still going on and on in the background, and they are still churning up, and the fraudsters are finding new typologies to get into the market and just try and exploit the banks, the customers as well. So take, for instance, if it is a student account, the student is coming to the UK, opens an account with a particular bank, and then when the student has finished the course, has that bank already closed the student account down, or has that data been already sold to a mule herder, and that mule herder is in charge of that account? So that synthetic data can fill in that gap, and it can ensure that before that account goes dormant or somebody else starts using it, warn the banks to say, okay, this student is going to finish by so and so date, and start reviewing those accounts like 3 months before, and just have it on the system, so clearly the bank can take an action and do it. Unlike we saw the press release coming from the Australian police a couple of days ago, where criminals are going and asking these students online and in person to sell those data directly to criminals, because end of the day they've got so many accounts and they can start laundering the funds out. So that was a very good press release coming from the Australian jurisdiction a couple of days ago. So that is one thing which can be looked at. Coming back to the pig butchering scams, now these scams have been really very difficult, hybrid nature. And romance scams and investment scams, these typologies are not new for the banks. They are in existence. They are, the rules still sit on the system. Transaction monitoring picks up, fraud prevention team picks up. But the combination now with the romance and investment, that is the biggest, what you can say, it is very difficult. And I cannot come out and say, oh, I've got a customer here who's a victim of pig butchering scam. You cannot say that. You can only say, oh, he's a part of a romance scam, but could be investment scam as well. But you cannot put that name directly. So to bridge those hybrid typologies, fixing your intelligence internally, and again, going and seeing what is the trend coming in your banking systems, what cases are getting reported, get them, fill up the synthetic data there, and it will go and help us to at least project in the future that if something like that happens, the bank was already warned, or the first line was already warned when these things are doing. So if we see the new SAR, NCSR best practice guidance, which just released a couple of weeks ago, nothing new in it, but NCA is asking us to focus more on intelligence side of it, rather than just filling up your SAR and sending it over, because end of the day, if you're filing it, it will, even a small piece of information would be a jigsaw to a very big case. So that is how, so the prediction should be more from a solution-based approach to more intelligence-led now.
And you mentioned there, Pallavi, something incredibly important. Our current systems don't encode the entire life cycle of these scams.
Yes.
These scams have key indicators that are happening during the actual scam. We have the grooming, you have the staging, you have the initial deposits where the person is paid for, let's say, the YouTube example. Oh,
Yes.
if you like these videos on YouTube, we'll pay you €5 or £5. Then there obviously is the kind of the cash, then we see different deposits coming through, and then we see different cash outs on the account. We can use synthetic data to basically run multiple thousands of different scenario testing and to develop targeted controls, help us identify very quickly these types of typology. And we're not just talking about scams, but even human trafficking,
Yes.
cyber-enabled fraud, cross-border crime. You know, this lets institutions retune thresholds on a continuous basis
Yes.
and adjust segmentation and basically refine investigative playbooks before the typology becomes statistically visible in their own book. And so that's what I said earlier in the introduction. We now need a mindset shift in our industry from detect once we see it to simulate before we see it. And that was actually the rationale to why I mentioned that. Okay.
And just on quick one on that, Onag, because I am currently talking to many of other people as well who are in the same boat. With the mule accounts, initially it was £1 followed by a large payment, and that was stopped at the transaction monitoring or the fraud prevention very immediately. But now it is like £1, test a payment, £10, £100, and £1,000. They are sent to other third-party banks just to do a dip test followed by no payments. So how do we map this behavior on all the banking systems that this person had just sent a pound one, nothing, no activity for next 6 months. So these accounts need to be coming, if there is synthetic data running, definitely these accounts need to be triaged to see what is actually happening on those accounts, or are those accounts getting ready for just the layering purposes, but you don't know the timeline, could be after 6 months, 12 months, 2 years, nobody knows the timeline.
And let's just kind of call it what it is. These accounts most likely have all been labeled low risk already. And we're talking here, especially in a retail scenario, of millions of customers. Yes. And these accounts are labeled as low risk. So the application of transaction monitoring rules on them to start with is minimal. We just have to be honest, because our focus from a regulatory perspective, we are trained to focus on that 20% of high risk in our book, because that's why we do a risk-based approach. But the absolute truth in modern financial crime evolution, the risk is in the low risk. That is the frightening situation, and that's really what's hitting the person on the street, and where we really need to change as institutions to be more proactive in protecting our customers. So we're coming up to the last kind of few minutes of our webinar today. I hope that everybody has got a lot out of this. Clearly, there is a lot of discussion around it. If I could say, maybe Eric, first to you, if you were going to develop a 3 to 5 year roadmap to a data first model within the institutions, what would that look like to start with?
So first of all, I mean, we've obviously been talking a lot about rules here, and I think the 3 to 5 year roadmap would move away from a rules-based approach, as effective and intuitive as that is, to a more AI-based approach, where basically you just like other areas of AI, you throw a lot of data at it and the AI figures out what are the interesting patterns. And just if I could give a quick analogy, American Express, in trying to detect credit card fraud, if you go back 20 years, they had a set of rules like we're talking about here. I mean, if you're making purchases in the middle of the night, it's more likely to be fraud than if you're doing it in the middle of the day, that sort of thing. In 2012, they moved to an AI-based system where they basically threw a lot of data at a model and trained it. And they found, first of all, they got an immediate 40% boost in accuracy. And then they found it was also much more adaptable. I mean, every week or every month, you feed in new data. And so new fraudulent patterns that are emerging, you immediately get. And I say that by way of both encouragement and analogy in terms of the 3 to 5 years. I think we should be moving on a similar sort of a trend here. And so I think synthetic data plays a key role in being able to develop these AI models and keep them moving forward.
Absolutely. Absolutely. And Pallavi, any kind of final words from yourself in respect from an industry perspective? One of the things I've recently, and in fact, even yesterday, I was speaking with 2 of our industry colleagues, with Alex Woods and with John Paul Eaton, was around the fact that we need more diversity of skill sets at the table. So we've talked a lot about data here. We've talked a lot about kind of what we can do better with technology, but we do need diversity of skill sets. So, and Alex Woods' situation, obviously, this is a previous fraudster who now works with government officials and works in the industry to help identify scam typologies and raise awareness. What are we not doing good enough at the table and why are we not bringing enough diversity in our skill sets into the room to help us innovate better in terms of identification and also with technology builds?
I can always put that point to the culture of silos, which has always been existing in the financial crime industry since the time I've started. So it is high time that all the KYC teams and the onboarding teams start working together, and KYC and fraud should be sitting together and start chatting up with each other as to what is actually happening, what are they seeing on onboarding. And if they have stopped somebody's onboarding, do they actually have the reasons why they have stopped that onboarding? Are they going and sharing that data with the fraud team? No, it is still not happening. On the fraud side, fine, they have stopped some payment, or there's a victim of fraud, they have logged the SAR, it comes onto the AML desk. But again, are these 2 teams speaking to each other? Not all the banks happens only in the small teams and the fintechs currently. But again, when you put it to the high street banks, 4 to 6 banks in the UK, again, it goes like a siloed position for there. So they should actually start merging the KYC fraud together, get the AML team as well. And sanctions used to always be the last, but given so many developments in sanctions should be coming up first now in any financial crime operations or something at that stage. So I can again put all the blame just to be on silos, and these departments need to start communicating, talk to each other, conduct your internal collaboration, start your meetings, have a monthly risk forum, and present to each other to say what are we actually seeing, how the bad actors are attacking our bank, and start getting that data together and get those minds. Because I know something in AML, but I don't know what is happening in sanctions. So that person will just boost up my knowledge and say, okay, this happened. Let us get that point on the AML side as well. How will that same point look on the fraud side as well? So this conversations need to start coming in than from the siloed process, which I really hate.
Yep. And last but not least, Nafisa, I would be amiss if I didn't mention, as Europeans, mention AMLA here. And if I'm going to be perfectly honest, in the 180 days, kind of what progress has been made and how are we currently looking at the progress of AMLA? And one of the biggest opportunities with AMLA was to get the cohesion between the FIUs, the financial intelligence units across Europe, for data sharing into banks to help us to help us with modeling of future proofing and scenarios of financial crime typologies. So I really, if you don't mind, kind of just very quickly, just to touch on that, what more can basically the FIUs and the regulators do to support us with innovation, especially as we look towards future proofing and increasing our technology capabilities, but with the need for real tangible data?
Yeah, because again, I will try to be brief because it's a huge topic that you just
that's another webinar.
Yeah, it's another webinar. But like as it was told, what we are seeing that we are moving away from alert-based world, and this all is about that. Because what would be better to do is look into a behavior-based, intelligence-driven models. And today we detect risk after it appears. We told that about that. But tomorrow we will model behavior before they materialize. So that's why all that is dynamic customer baselines, network-aware risk signals, early stage pattern recognition for scams and mule activity that Pilavi told, all these will mirror their direction regulation are already pushing. Under all these regulations that we mentioned today during our webinar, and we didn't mention also DORA, UAI completely on a different scale, and all these expectations. But I would say, I just wanted to tell that in synthetic data, it's all great what we have told now. Everything is good. However, they would never they can't replicate the unexpected criminal behavior, because the synthetic data based on AI, they will. What does it mean? They just have these patterns. They understand this pattern, they recognize pattern, and they really help. Yes, they help us on onboarding, they help us on transaction monitoring. However, the real synthetic data, the real unexpected criminal behavior, it's quite difficult to capture. I'm just that's it.
No, it's amazing we said. And and the thing is that it's a completely new webinar, and I wanted to mention it because basically that's the next webinar we want to look at, the first 180 days of AMLA, and what that means for us as an industry. So just to kind of round up today, we are redefining the next decade right now of AI and of AML innovation. The shift that we are facing is not merely technology. It's going to require new skill sets, new governance structures, and a new way of thinking about how criminals operate. But the opportunity is immense. Synthetic data enables a world where detection is no longer reactive, but anticipatory, where transaction monitoring is not bound by history, but empowered by the simulation within our systems, and where privacy and innovation reinforce, not oppose each other, which is something we actually haven't seen to date. So the future of AML belongs to the institutions that recognize one simple truth. Crime is evolving faster than our systems, but with the right data, we can evolve faster as well. So on that note, I would like to thank Eric, Pallavi, and also Nafisa for their incredible contributions to today's webinar. I hope you've all enjoyed it. Apologies we weren't able to get through all the questions that were being asked, but if you want to contact any of us after the event, please feel free to reach out to each of us respectfully on our LinkedIn profiles. But on that note, thank you very, very much for being part of our webinar today. Apologies for our slight run over. And we're looking forward to welcoming you back in January with our new webinar series for 2026. Thank you, everyone.
Thank you.
Thank you. Bye-bye.
Thank you.